Want to trade futures but don't know how to read a chart? Don't worry. You don't need to learn dozens of complicated indicators to understand technical analysis. In this video, I'll explain technical analysis for futures trading in simple terms. You'll learn what technical analysis is, how to read price action, how to identify trends, support, and resistance, and how to use these ideas to build a simple trading plan. Let's get started. So, what exactly is technical analysis? Technical analysis is the process of studying price charts and market data to identify potential patterns and trading opportunities. Instead of trying to predict the future, you're looking at what the market is doing right now and what it has done before. Traders commonly study things like price action, trends, support and resistance, volume, and indicators. The important thing to understand is this: technical analysis doesn't guarantee that a trade will work. The first skill you need is understanding candlesticks. Every candlestick shows price movement during a specific period. It tells you four important things: the opening price, the closing price, the highest price, and the lowest price. The body shows the difference between the opening and closing price. The wicks show how far price moved above or below the body. A series of strong bullish candles can show buying pressure. A series of strong bearish candles can show selling pressure. But don't look at one candle by itself. Always consider the candle in the context of the overall market. Next, learn how to identify the market trend. There are three basic conditions. An uptrend happens when price generally creates higher highs and higher lows. A downtrend happens when price creates lower highs and lower lows. And a sideways market happens when price moves within a range without a clear direction. Now let's talk about support and resistance. Support is an area where buyers have previously shown interest and price has reacted upward. Resistance is an area where sellers have previously appeared and price has reacted downward. These aren't always exact lines. Think of them as zones where price may react. When price approaches an important support area, traders watch for signs that buyers are returning. Near resistance, they may watch for signs of selling pressure. But remember, support and resistance can break. That's why you should never assume a level will hold just because it worked in the past. Another important part of technical analysis is volume. Volume can help you understand how much trading activity is happening behind a price move. For example, a breakout accompanied by stronger volume may attract more attention than a breakout happening on very low volume. Traders also use indicators such as moving averages, RSI, and MACD. Now let's put everything together. A simple technical analysis process could look like this. First, identify the overall trend. Second, mark important support and resistance zones. Third, wait for price to reach an area you're interested in. Fourth, look for confirmation from price action, volume, or another part of your strategy. And finally, define your risk before entering the trade. This last step is extremely important in futures trading. Futures use leverage, so losses can happen quickly. Never focus only on where you could make money. Always ask yourself how much you're willing to lose if your analysis is wrong. So, before we finish, there's one more technical analysis concept you should understand: multiple time frame analysis. Instead of looking at only one chart, traders can use different time frames to get a bigger picture of the market. For example, you might use a higher time frame to understand the overall trend. Then, you can move to a lower time frame to look for a potential entry. Think of it like looking at a map before choosing a road. The higher time frame can help you understand the bigger direction. The lower time frame can help you study the smaller price movements. But don't make the process too complicated. You don't need to watch 10 different time frames. Start with 2 or 3 that fit your trading style. For example, you could use the 1-hour chart to understand the broader market structure, and then use the 5-minute chart to look for a possible entry. The important thing is consistency. So if you're a beginner, don't try to learn everything at once. Start with candlesticks, market trends, support and resistance, and basic volume analysis. Then practice reading charts and build a simple, repeatable process. Technical analysis isn't about predicting every move.